Many real estate syndicators are really good at raising money. So one of the questions I get all the time is, Mauricio, how do I go about getting compensated in a legal way for doing all of this capital raising? And so in this video, I'm going to walk you through the 6 ways you can legally get compensated to raise money. So without further ado, let's get to it. Number 1 is raising capital for yourself. That kind of seems obvious, but the whole premise about all these rules is when you start raising capital and getting compensated for raising capital for others. But if you're raising capital for your own account, or even if you, obviously you're going to set up an LLC, right? You're going to set up a fund. Even if you're raising capital for that fund and it's just you, it's generally considered that you're raising capital for yourself. Not so if you have multiple GPs. So once you get into the co-GPs, you really are raising capital for that particular syndication LLC. Number 2 way of getting compensated legally is getting a broker-dealer license, right? So a broker is anybody who is in the business of transacting securities, buying and selling securities for compensation. Generally, broker-dealers get a commission. Generally, being a broker-dealer from this standpoint seems like the greatest thing of all times. The issue is it's just a nightmare to get a broker-dealer license. It's not something to take lightly. It takes a lot of money and a lot of time. Last time I checked, it was actually cheaper to just buy a broker-dealer's firm. That was like 500 grand just to buy it. And then all the regulatory nonsense that you got to deal with after that, all the compliance and the audited financials and the strict rules, it just isn't something that in our community that we would look for. So I wanted to bring it up because it's important about some of the exemptions to it, but I don't think anybody in our community should even consider becoming a broker-dealer. And if you do, let's have a conversation offline. What's more logical and makes probably the most sense is number 3, and number 3 is becoming a registered representative. Now that's slightly different than a broker-dealer in the sense that it's the same analogy in real estate, right? When you pay a real estate agent a commission for selling your home, you're technically not paying the commission to the agent, you're paying it to the brokerage. It's a real estate broker, and then the real estate agent hangs their license under the brokerage, and so you pay the broker the 3%, the 6%, whatever it is, and then they split that fee with their agent. Same thing with a registered representative. You actually pay the commission, literally the transaction-based commission, to the broker-dealer who has hired or has the registered representative under them, and so they split the fees. And generally, I was just listening to, I'll give a shout out to Hunter Thompson. He's done that route, and I think he mentioned in one of his podcasts that he has to split about 15 or 20% of his fee. So the fee goes to the broker-dealer keeps 15, 20, 25%, whatever you've arranged with them, and then you get the rest. But that is a cleanest way to actually get compensated for actually raising the capital and getting a commission. Now, in my world, where I've seen this a lot, not a lot, in the places where I have seen broker-dealers involved, at our level, I've seen that they combine charging a commission and also taking a cut of the GP. So generally, if you're looking at the big broker-dealers that don't like to get out of bed for less than $50 million or whatever, they're charging you a flat commission, 7-8%. Hey, I bring you $1 million, you're going to pay me whatever 8% of that is, 80 grand, 100 grand. But what these registered reps and the broker dealers at our level, they're usually charging a hybrid. So they're charging a smaller commission, maybe 2 or 3%, but also a cut of the GP depending on how much they raise. But the nice thing about this arrangement is that you can absolutely take transaction-based compensation. You are flat out doing it the legal way by getting that license. Now, in order to become a registered rep, you do have to go through a lot of examinations that you have to take. There's a general examination that you take. There's a Series 65 exam that you have to take. There's a couple of other exams you have to take depending on the type of securities you're going to sell. So Series 7 is sort of the basic, and you can sell anything, stocks, bonds, mutual funds. But if you're a syndicator or you're going to play in that space, you probably don't need all of that stuff. So I know other people have taken different types of exam. I think it's a Series 22 or Series 23, which allows you specifically to sell private placements, which is probably what you're looking for. You know, it's much less regulatory than becoming a broker-dealer. And I think if you're really good at raising capital, then this is definitely a road that you should look into, especially if you're thinking of raising $5, $10, $15 million a year, or you have that ability. Becoming a registered representative and hanging your license under a broker-dealer is something definitely to take a look at. The 4th way you could legally do it is by relying on one of the exemptions to becoming a broker-dealer, which is what we call as the issuer exemption. And this is what most people rely on when we're doing a co-GP arrangement, right? So when you're a co-GP, you're technically raising money for others. You're considered an associated person. You're associated with the issuer, the LLC that's actually your syndication LLC that is actually selling the security. You're an associate of that. And so the general rule would be, hey, you're raising money for that syndication LLC, you need a broker-dealer license. And of course, that doesn't happen. And the reason is because there's an exemption called the issuer exemption. And it allows you to not have to register as a broker-dealer so long as you fulfill certain requirements. And we've talked about a lot of those requirements in the past. I've done a lot of videos on this, but just to summarize, there's basically 3 things that you have to comply with in order to fit under the issuer exemption. Number 1, you cannot take any transaction-based compensation, meaning you can't charge a percentage of how much money you bring into the deal, whether that's cash or whether that's GP interest, which I think is the big one that people sort of miss, where, hey, if I raise 500 grand, you'll give me 2% of the GP. If I raise $1 million, you give me 4% of the GP. That you cannot do because you cannot get transaction-based compensation. You also have to be doing what's called substantial duties, which is a very nebulous term. Nobody's really sure on what that means, but you've got to be doing the thing. So everything that a syndicator does, which obviously involves a lot more than simply raising capital, it involves doing the underwriting, the due diligence, the talking to the attorneys, the putting the pitch deck together, investor relations, asset management, hiring the property manager, all those roles that come into a syndication. You've got to be doing some of those roles and having a substantial responsibility, right? You can't just be raising capital. You have to be doing substantial duties. And then the third requirement is that your primary role in the syndication must be doing those substantial duties, meaning you cannot primarily be brought in to raise capital. That to me is easy. It's 50% plus one. Just look at how much time you're spending in the syndication. If you're spending more time raising capital and no time or very little time on the actual deal, you're probably going to fail to primarily engage in those substantial duties. Because remember, what you really need to be paying attention is to once that deal closes, once the offering is done, you've raised all the money, you've closed on the property. Now, what are you doing? I mean, are you doing anything, or did you just bring all the money and now you're just kind of sitting back at the couch at home, or maybe participating in some of those calls? But that's where you really, the SEC wants you to be involved is in that asset management piece once the offering itself is completed. So that's the issuer exemption. That's the one that most people use with the co-GP model, which, as you guys probably know if you've been listening to my content, is I think that model has been abused a lot. I think a vast majority of people who have multiple GPs are likely being non-compliant. There's way too many people out there that are literally primarily engaged in raising capital. In fact, they're calling themselves capital raisers, which I think is a disservice to yourself because that kind of becomes an issue. But anyway, I've done a ton of videos on that. But because of that, I think what's happened is a lot of people are starting to move into way number 5 of legally getting compensated to raise money, which is the fund to funds model, right? Which is, instead of you co-GPing with someone, well, why don't you create your own syndication, your own SPV or single purpose vehicle, raise the money from your investors into your own LLC, and then turn around and invest in other people's deals, become LP owners or LP members in those particular syndications. And so then the argument is, well, I'm not getting compensated to raise money for others. I'm getting compensated at that point, literally for my own account, because it's my syndication. It's just me. I've got one LLC. I'm putting all the money in there. That is a great model to do. Again, I've done a lot of content on funds of funds. The things you want to just keep in mind there is the slight nuance, which is instead of you now raising money in your syndication to go buy real estate, what you're doing now is you're raising money to go buy securities. You're buying, stock in somebody else's company, or in this case, limited partnership interest in somebody else's deal, or LLC units, whatever you want to call it. But you're now buying a share of the company, a passive share of that company, which means you're buying securities, which now opens you up to a whole new bunch of regulations, for lack of a better word, including making sure that we avoid becoming an investment company, because you may have to register under the Investment Companies Act of 1940, which you want no part of that. So you want to make sure you find an exemption there. You're most likely a registered investment advisor, because the states and the feds look at you as advising your syndication as to the purchase of securities. So that typically makes you an investment advisor. And that doesn't necessarily mean at the end of the world, doesn't mean that you have to go register anywhere, but that usually will become a state by state issue. And you're going to want to look at your particular state, find out what's the exemption, so I don't have to go register as an investment advisor. And then the other thing you just want to make sure is, and you still cannot get compensated for simply raising money for other people. So you want to make sure you're adding value to your syndication to avoid the argument that anybody could say, well, yeah, this is just a bunch of smokescreen. You're just basically raising money and giving it to Johnny over here, and you're basically acting as an unlicensed broker. And the way we do that is just making sure that, hey, you're letting everybody know that you have expertise in this area, that you're going to go underwrite this deal yourself, that they're relying on your expertise to do this. You've ideally negotiated better terms for your investors with this fund, because if you're going to bring in $1 million or $2 million, there's no reason why the sponsor, in fact, I've asked the question before, what sponsor would be open to providing some kind of discount or some special provision if somebody came in with $1 million or $2 million into the syndication, and they're all willing to either give, discount on their fees. So maybe the acquisition fee, instead of being 2%, is 1%. Maybe they charge less of an asset management fee to you, or sometimes they'll just do a big carried interest discount. So instead of, let's say it's a 70-30 deal where the investors are getting 70%, well, maybe you can negotiate that you get 75% or 80%. So little things like that, you're adding value to your investors. So you're not considered somebody who's just putting up a smoke screen and some entities so that you can raise monies for other people. So that's kind of the 5th way to do it. And the last way, the 6th way, is through finder fees, right? So finder fees are another good way to get compensated, but it's not to get compensated for helping other people raise money. Finder fees, what you're doing is getting compensated for making the introduction itself. It's the actual act of making the introduction that allows you to get compensated, generally a flat fee as well. You don't want to be taking any transaction-based compensation, meaning I'm going to get paid if that referral ends up investing, because that, again, transaction-based compensation is the hallmark of broker-dealer activity. But if I'm simply making the introduction, I'm not involved in the negotiations, I'm not giving my advice as to whether this is a good deal or not, but it's like, hey, Jared, I know that you're looking to put some money into a deal. I know that Jonathan has one. Let me make an introduction. And you make an introduction and get compensated for that introduction, whether, Jared ends up investing in that deal or not, then potentially you got a finder's fee. One word of caution on finder's fee is that there are some states out there that have actually codified the ability to take finder's fees, like California and Texas, I believe, also has one. But remember, you have to comply with both state and federal rules. So you may be in a position where you're following the rules of the state of California, for example, and I'll give you a specific example in California, but you might be violating the rules at the federal level. The one that comes to mind the most is that California actually allows you under their statute to take transaction-based compensation for a finder. So in other words, if I find somebody and refer you to somebody, the statute does allow me to take transaction-based, meaning a commission based on the amount of money that that person ends up doing. The problem is the feds don't recognize that. So you'd be okay on the California finder fee rule, but you'd be violating federal rules in terms of taking a transaction-based compensation. Finder's fee is really threading that needle. You've just got to be it's a very narrow exemption. And if you can fit your little needle through there, then that may be an option. But I think for most people, what most people are trying to do, that won't work. But I wanted the guys to know that's out there. So anyway, so those are the 6 ways: the raising money for yourself, getting a broker-dealer license, becoming a registered representative. Number 4 would be funded funds. Number 5 would be the issuer exemption. Maybe I flip those over. And then number 6 is the finder's fee. So if you enjoyed this clip and you want to see the entire episode, click here. And if you want to see other videos similar to this, click here.